Have you ever wondered how massive global companies, or even the super wealthy, actually manage their money? I mean, it seems so complex, right? A whole world of shell companies and offshore accounts. But what if I told you that the legal tool at the very heart of all of it was actually invented by medieval knights who were heading off to the Crusades? And that the people who untangle it all when things go wrong are the direct descendants of the accountants who finally took down Al Capone? Yeah. Let's dive into this, because from ancient land disputes all the way to modern digital forensics, it is all one single fascinating story about how wealth is protected, how it's hidden, and how it gets found.
Okay, so here's our roadmap for this journey. We're going to start with that medieval invention that changed everything, the trust. Then we'll see how that simple idea was scaled up into this huge, vast web of global corporations. After that, we'll look at the massive international effort to regulate this whole system. And finally, we'll meet the detectives, both past and present, who follow that money trail when it's being used to hide a crime.
So, our story doesn't begin in some high-tech boardroom. Nope, it begins in feudal England. Landowners, especially knights who were about to go off to war, had this huge problem. How could they make sure their family would be taken care of, and that their land wouldn't just be seized by the king if they didn't come back? Their solution was this, well, an ingenious legal workaround that would literally echo for centuries.
What they invented was the trust. The easiest way to think about it is like a financial safe deposit box that comes with its own manager. The knight, he's called the settler, would transfer the legal ownership of his land to a trusted friend, the trustee. Now, the trustee's name is on the deed, but, and this is the key, he has a binding duty to manage that land for the sole benefit of the knight's family, who are called the beneficiaries. This created a revolutionary split. The person who legally owns the asset is completely different from the person who actually gets to benefit from it.
Now, what's really fascinating is how this whole thing came to be. It was born from a legal clash. You had the traditional common law courts, which were super rigid. They'd look at the deed and say, hey, the trustee's name is on it, it's his land, end of story. But then there was this other court, the Court of Chancery, and it operated on a principle called equity, which is really just a fancy word for fairness. The chancellor would say, hang on a second, we all know the intention here was for the family to benefit. And by enforcing that intention, the Court of Chancery basically created a second layer of ownership, and just like that, the modern trust was born.
So this idea of separating legal ownership from the actual benefit, it was powerful. So powerful, in fact, that it eventually got scaled up from just protecting a single family's estate to organizing the largest multinational corporations on the entire planet. And it did that through a structure we now call a holding company. Let's see how that happened. A holding company is pretty much the corporate version of a trust. See, it doesn't actually make widgets or sell coffee itself. Instead, it owns the assets of the companies that do. The shares, the patents, the cash. It acts as the central brain and nervous system for the whole operation. This allows a global business to manage its finances, protect its assets, and plan its strategy, all from one central, legally optimized location. And the really crucial part is choosing where to put that brain.
And that choice has sparked a global competition. I mean, just look at how different countries have carved out their own little niches to attract these corporate headquarters. A company might pick the Netherlands for its participation exemption, which is a really powerful way to avoid getting taxed twice on dividends. But if you're a tech company all about growth, you might look at Estonia. They have this revolutionary system. You pay 0% tax on any profits you reinvest back into the business. You only pay tax when you actually take the money out. Singapore is seen as the gold standard for its amazing infrastructure, while Luxembourg is this premium, super stable hub for financial services. We're talking over 300 licensed banks there.
And yeah, choosing a premium location. It comes with a premium price tag. The first-year setup costs in a place like Luxembourg can easily top 13,000 euros. So this isn't about finding the cheapest mailbox you can rent. No, this is a strategic investment in stability, in legal expertise, and in getting access to a huge network of tax treaties. But as these structures got more and more sophisticated, so did the game itself.
You see, for decades, companies could strategically place these holding companies in low-tax jurisdictions and dramatically shrink their global tax bill. But, eventually governments and international bodies decided, okay, this game has gotten a little too one-sided. And so they began this huge coordinated pushback, creating a whole new era of regulation. The goal? To make sure profits get taxed where the real economic activity is actually happening.
This led to what you see here, a classic alphabet soup of new rules. You've got the OECD's BEPS project, which targets strategies that shift profits around. Then there's the EU's Anti-Tax Avoidance Directive, or ATAD, which implements a lot of these ideas across Europe. CFC rules are there to stop companies from just parking money in low-tax offshore accounts. And then there's the PPT, the Principal Purpose Test, which is this really powerful catch-all. It basically says if a primary reason you did something was to get a tax break, that tax break can be denied.
And at the heart of all these new rules is this one absolutely critical concept: economic substance. The days of having a holding company that's just a P.O. box and a name on the door, they're over. To get the benefits of a country's tax system now, a company has to prove it has a real, tangible presence there. We're talking qualified local directors making real decisions, holding board meetings in that country, and even having real local employees with real salaries. For instance, the Netherlands now requires some companies to have at least half their directors be local residents and spend a minimum of 100,000 euros on local salaries. Bottom line, you have to prove you are really there.
Now, these incredibly complex structures, they aren't just used for tax planning. Their ability to create layers of secrecy and separate ownership from control also makes them the perfect tool for hiding the proceeds of crime, everything from embezzlement to money laundering. And when that happens, you don't call the police. You call a very, very different kind of detective.
And this brings us to one of the most famous gangsters in history, Al Capone. The man was a notorious criminal, into everything from bootlegging to murder. The feds tried for years to pin something on him, but they could never make it stick. And then an IRS accountant named Frank Wilson got the case. He didn't look for guns or bodies. He just followed the money. His careful, painstaking analysis of Capone's finances led to an indictment for tax evasion. Capone went to prison not for being a gangster, but for owing the government $215,000 from his illegal profits. And that story perfectly illustrates the power of forensic accounting.
So what exactly is a forensic accountant? It's really important to know they are not the same as a regular auditor. An auditor's job is to make sure financial statements are accurate and free from honest errors. A forensic accountant, on the other hand, comes in assuming something is already wrong. Their job is to hunt for deliberate fraud and deception. They're part accountant, part detective. And they're not asking, is this correct? They're asking, where did the money go?
The best way to think about what they do is as a kind of financial archaeology. You know, just like an archaeologist pieces together a lost civilization from scattered artifacts, a forensic accountant reconstructs a story of fraud from a trail of invoices, bank statements, and transaction logs. Every document is a clue, another piece of the puzzle that, when you put it all together, reveals a clear picture of deception. They are literally rebuilding past events to find a hidden truth. But today, those artifacts, they're not on paper anymore.
This whole cat and mouse game has now gone fully digital. Financial crime today is faster, way more complex, and more global than ever before. And that means the forensic accountants of today have had to completely evolve, adding a whole new set of high-tech tools to their detective kit. The challenge they're up against is just immense. I mean, think about it. How do you find one single fraudulent transaction that's buried in millions, or even billions, of legitimate ones, all scattered across the globe? A human being can't possibly sift through all that data. The answer is, you get a machine to do it for you.
So, a modern investigation looks something like this. First, they collect all the data. I mean, everything. Then, they unleash powerful tools like predictive modeling and machine learning. These are algorithms that are trained to spot weird anomalies and patterns that indicate fraud, stuff a traditional audit would never ever catch. They also use network analysis to literally map out hidden relationships, visually connecting shell companies and people in a way that can instantly reveal a criminal conspiracy. And finally, they package all of this digital evidence into a coherent story that will actually stand up in court.
And that brings us right back to the fundamental question at the heart of this entire story, from that medieval knight to the modern-day coder. The tools for managing wealth and the tools for investigating its misuse, they're locked in this perpetual arms race. As one side innovates with a new legal structure or a new digital currency, the other side develops new regulations and new forensic tech to keep pace. So the real question is, in a world that is only getting more and more complex, can the chase ever truly end?